Okay, Bismillahirrahmanirrahim. Now let's look at the static budget report. So what is a static budget report? So a static budget report is a projection of budget data at one level of activity. So now you are looking at a single level of activity. So when used in budgetary control, each budget included in the master budget is considered to be static. So you ignore the data for different levels of activity. So because you are looking at only a single or one level of activity, so you ignore the different level of activity. Okay, and then compare actual results with the budget data at the activity level used in the master budget. Whatever that you have used in the master budget, so that level of activity will be used to compare between your actual and your plan results. Okay, now let's look at the example here. So you have this one, budget and actual sales data. So this one is about sales. Then you are looking at the sales data for right product in the first and second quarters of 2022. So you have the sales budget. So this one is the static budget report. So okay, now I am explaining to you about the static budget report, and you are looking at the sales. Okay, we are looking at the sales, the budgeted and the actual, and then we are looking at the first quarter as well as the second quarter. So first quarter, you have budgeted your total sales to be 180,000. Okay, you in ringgit, okay, in value, monetary value. Okay, assuming it is in ringgit. So you budgeted this figure to be 180,000. But what happens to when you found out that at the end of the first quarter, you found out that the actual result is 179,000. You found out that it is only 179,000. So how much is the difference? How do you get the difference? It's just 180 minus 179. So you've got 1,000. So that 1,000 is the difference or the variance that you have. Okay, and then you go for the second quarter. You have budgeted 210,000, and then you found out that your actual results at the end of the second quarter, you found out that your actual results is 199,500. So you have a difference of 10,500 ringgit. Okay, so if you look in total year to date, that means up to that particular period of time. So based on your budgeted 390,000, so you just add 180 plus 210, so you will got 390. And then for your actual results, the first quarter is 179, and for the second quarter is 199,500. So you add all these two together, you will get 378,500. So if you look at the difference for the second quarter, the difference is 1,000. For the second quarter, to 10 minus 199,500, you will get 10,500. So the total difference will be 11,500. So that's how you prepare this one. So this one is the static budget report for your sales. Okay. So in this case, if you see your sales budget report for the quarter ended March 31st, 2022, so that means for the first quarter, if you prepare the report for the first quarter, then you can see the product line that you have for the budgeted, it is 180,000, and you found out that the actual results is 179,000. As we have calculated earlier, the difference of 1,000, this one is unfavorable. It's either favorable or unfavorable. So you will have your unfavorable. Why do you have unfavorable? Because if you see, you are talking about sales or revenue. Revenue, of course, we want to have a higher revenue and a lower revenue. Which one is better? Which one do you want? Of course, you want to have a higher revenue. So a higher revenue, that means we have budgeted for 180,000. But the actual revenue that we get is only 179,000, which is lesser than what we have expected. So there comes in your unfavorable variance, or the difference of 1,000 is unfavorable. You should have get more in terms of the sales. You should have get more. Okay, so this one is unfavorable. favorable. What about the second quarter? Now let's look at the second quarter. So for the second quarter, again, you have budgeted for you to get a income or revenue. You expected that you will get a revenue or sales for 210, but you only get 1,995,000. So again, there is a difference of 10,500. So that 10,500 is for the second quarter. So for the second quarter, again, you have unfavorable variance. Okay, so you have favorable or unfavorable. In this case, you have unfavorable variance. So for the year to date, you can see the total. The total is 11,500. Again, 11,500 is considered as unfavorable variance because in total, you should have got 390,000, but you only got 378,500. So a difference of 11,500 is unfavorable variance. That's how you prepare for your budget report. This one is considered as a static budget report. So, static budget reports in terms of the uses, when should you use? So, it is appropriate for evaluating managers' effectiveness in controlling costs or revenue when the actual level of activity closely approximates the master budget activity level, or when the behavior of cost is fixed in response to changes of activity. Okay, so therefore it is appropriate for fixed costs and not appropriate for your variable costs. In other words, it is more appropriate to be used when your level of activity tend to be a constant, or there is not much changes in the level of activity. And in terms of the behavior of your cost, as we have learned before, your cost can be variable, your cost can be fixed. If the nature of your cost, most of your costs are fixed costs, then static budget is appropriate to be used. Okay. So for your to test your understanding, a static budget is useful in controlling costs when cost behavior is it mixed, is it fixed, is it variable, or is it linear? As I have just mentioned just now, it is useful when the cost behavior is when your cost behavior if is fixed. All right. So hopefully you have a better understanding on what is a static budget and how to prepare a static budget report. Okay, with that, I thank you.